From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for July 18th, 2025. Well, the Brewers are on the West Coast this week, but we have a ton of stuff for you to check out this weekend. Here's just a very small sample. First up, Bastille Days is going on right now, and the Air and Water Show with the Blue Angels is back at the lakefront Saturday and Sunday. And for something a little different, on Milwaukee's east side, Black Cat Alley After Dark. It's an art show lit up by the streetlights. They have adult beverages and food on Saturday if you're looking for food and art. Okay, let's get started in New York City. Suzanne Reisman is a self-proclaimed rat whisperer, and she leads walking tours through Manhattan's filthiest alleys and neighborhoods. The tour costs $40, but you'll learn disgusting facts about rats, most of which are not appropriate for this podcast, but here's one. Did you know that rats have sex up to 20 times a day? Just something to file away when your next trip takes you to the Big Apple. This one sounds like it could be a horror movie too, but it's real life. The U.S. government is preparing to breed billions and billions of flies to dump out of airplanes over Texas. The flies are part of an effort to fight off flesh-eating maggots. This has to be good for tourism. These maggots are known as man-eaters, and they're a danger to cattle, wildlife, and even household plants. I don't believe there are enough pest strips on the planet to solve this problem. And finally, in Tuscaloosa, Alabama, police are looking for a thief wearing a Scooby-Doo costume. He broke into a Quick Mart and stole cash, but no snacks, according to the police report. No Scooby snacks? That's a pretty hip police department. On the podcast today, we have Art Rothschild, Steve Giles, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max, and apologies in advance if we're interrupted by some planes flying outside. It tends to be this time of year in which the podcast seems to coincide with the Air and Water Show here in Milwaukee that we do get interrupted on occasion, so you might hear them in the background. A mixed week overall for markets, but mostly positive. The Nasdaq up 1.5%, up 310 points this week, closing at 2896. The S&P up 0.6%. That's 37 points, flirting with 6,300, closing at the bell at 6297. The Dow Jones Industrial Average, just a small decline on the week after a 142-point drop on Friday, closing down 0.1% at 44,342 for the year. NASDAQ now up 8.7, the S&P up 7.8, and the Dow Jones Industrial Average up 5.2%. Art, interesting week overall. I think no shortage of headlines to point to, no shortage of ongoing conversations, tariffs, Fed, whatever you want to point to. And yet, here we are, now more than halfway through the year, a really strong market overall. And I think, flirting with new records, maybe some things clients can be, I think, happy about, investors can be happy about, despite some of the uncertainties that are still out there.
Yeah, this is one of the most unique years, probably the most unique year I can think of. We talked about in prior podcasts, we've talked about the Liberation Day, the threat of tariffs potentially driving the economy into a recession. That was all the talk in early April. We got through that. As the end of June, we're making money. This week, we set more records on the NASDAQ. We had 4 days in a row in which the NASDAQ hit records. Ninth record of the year for the S&P 500. As we're doing reviews with our clients, they're surprised. They're not looking at it all the time, fortunately. They're not looking at it as closely. And, when they realize how bad things were or look back at how bad they thought things were, and then they're looking at statements, that show them maybe even beating the S&P year to date with less risk, they're appreciative and relieved. Now, the question is always what happens next. And we don't want to get complacent about the markets. That having been said, if we can get through what we just got through in terms of the threat of a recession and the fact that tariffs are still out there, I'm thrilled at where we are year to date, and can only hope it continues.
Yeah, as am I. Again, an S&P pushing almost 8%, including dividends. It's really hard in a year in which we've had as many kind of moving pieces as this one, for that to be a full year number, let alone halfway. Now, I'd argue that it probably has to slow down a little from here. It's, I think, a fool's errand to try to forecast, especially near term. And yet, I think it's a pretty reasonable expectation with where valuations are. Steve, I know you're ever the proponent of balance, and I think with the forward earning in the S&P 500 pushing 22.5 now, maybe now more than ever, that reminder, as Art was talking about, that we need to avoid being complacent.
Yeah, for as good as the markets have recovered here since April, that PE ratio of 22.5 gives us an earnings yield on the market of 4.45. The 10-year Treasury this week closed at 4.43%. The point here is that it's a horse trade between whether or not you want to put your money into stocks or bonds. And for all the years that we've been talking to people on our podcast, the one thing we always come back to is, hey, look at the earnings yield versus the 10-year Treasury yield, and that's going to give you a sense of where the big money is going to go. And right now, it's a coin flip. I think it's important for investors to recognize that as good as the markets have been, there's another game in town, and that's fixed income.
And not as boring as it used to be, not maybe as low yielding as it used to be. And so for investors looking at those alternatives, I think you're right to point that out.
I have helped so many clients take money they've had sitting in the bank and buying CDs. For all those investors who have been watching the Fed and wondering whether or not Jerome Powell is going to lower rates, we have to remind ourselves that by keeping rates where they are, we've continued to see our bonds, our savings accounts, our CD rates all stay in a nice, juicy 3.5%, 4.5% range. For those investors that have fixed income, they appreciate rates kind of where they are right now.
No, I think that's fair. And you mentioned the Fed. I think it's hard to ignore what has been a pretty regular conversation now about will he, won't he get rid of Jay Powell? Will Jay Powell and the Fed cut rates? Will they leave them where they are? And I think we are in the middle of what is a pretty significant misunderstanding of the Fed's role. And important just to take a moment to remind listeners that the Federal Reserve is, by its very creation, an independent body. It is supposed to do just a very few simple things. At its creation as part of the Federal Reserve Act, the Fed's objective really was as the lender of last resort. There was really no other mission, no other objective the Fed followed through on. And then through years, the mission evolved a little bit, coming through into 1977 with an amendment to the Federal Reserve Act that really created what we know today as the Fed's dual mandate. That dual mandate is price stability, an inflation target of 2%, which is what it's now become, and maximum employment. And so when you see headlines like the Federal Reserve is costing the U.S. money, that rates are so high that we have to pay more on our debt than what we otherwise should have to pay if we just cut interest rates, well, I think it's important to remember that the Fed's job is not to control the cost of our debt or our deficit. The Fed's job is, as prescribed by Congress, as mandated by Congress, price stability and maximum employment. And so I applaud Jay Powell. I applaud the Fed for sticking to their guns on this. It isn't about doing what an administration wants. It isn't about doing what a political party wants. It's about doing what they are congressionally mandated to do. They understand the assignment and they've followed through. The challenge, of course, is that they're driving while looking out the rearview mirror. They only have data on what has happened. They don't know necessarily where things are headed. And so some of the conversation is going to evolve over time to here's what we see coming. But I do want to stress that we have to be clear about what the Fed's role is and not stress parts of the responsibility that should fall in other areas in placing that blame on the Fed. And then, of course, Art, you rightfully point out in your notes before the show that more than anything, perhaps this is a scapegoat that we can point to at times of stress, at times of maybe weaker than expected growth to go, well, if only we'd done this different. But I think it points to a number of other things maybe that are going on, and the Fed is just, part of that conversation.
And they've done a great job. They don't get enough respect, quite frankly. They don't get enough appreciation. If you look at this individual who happens to be, chairman of the Federal Reserve Board at this point, it's one man, okay? It's a committee that makes the decisions. And so to a certain extent, as you indicated, it is a distraction to pick on the guy. Here's the guy who got us through the pandemic sell-off by lowering interest rates and restarting quantitative easing. They've got a great track record. Sure, he'd been faulted for not raising interest rates soon enough in recognizing that inflation was anything other than transitory after the pandemic or during the pandemic, but the markets were wrong in thinking that his raising rates was going to cause a recession. It didn't happen. And so we got through the 2022 sell-off, followed by 2023 and 2024 spectacular gains, led, of course, by tech stocks. But nonetheless, here we are with all this criticism of Chairman Powell, when any respectable economist is going to recognize the fact that the Fed has done a great job and is continuing to do a great job in the face of these attacks. And the last thing we want them to do is to diminish their integrity by doing something that's inappropriate. Now, the argument is a good one, that we should be lowering rates, and I think that's going to be their next move if they feel they can do so without fanning the flames of inflation. And unemployment, one of their two mandates is keeping unemployment at a good level. Unemployment is at 4%, give or take. That's excellent. And the inflation, quite frankly, we had some figures this week. I'll let you get more technical, or Steve get more technical on the numbers. So inflation went up a teeny tiny this week, didn't spook the markets. I think it's sad that he has to Chairman Powell has to undergo those attacks. But again, it's a sideshow. Hopefully he makes it through his term and the Fed continues to do what they're supposed to be doing.
Well, and I think we need the confidence of the independent Fed to really support the foundation of our economy, right? That part of what makes our economic engine run is the fact that you have a Federal Reserve that is not tied to the rest of the economic engine, that they're making those decisions independent of any other governing body. And so I do think that is what has given a lot of the rest of the world confidence that they can park money here. And in many ways, if you shake that confidence by cutting rates prematurely, if you shake that confidence by bending to the political will, then it actually probably works against you longer run, in that it means borrowing costs go up, not down in the rest of the market. Steve, Art mentioned some of the economic data this week. Anything in particular really jump out at you as we come through a week in which we had some inflation data, consumer sentiment, things I think that are kind of core to what has been part of the conversation?
Yeah, I think the two things that jumped out at me were certainly the CPI numbers. Inflation did tick up a little bit. It's the highest since January. You had CPI coming in at 2.7%, and when you remove food and energy and just look at core CPI, you're actually up 2.9% from June of 2024. The reason why this is important is because inflation is what's most associated with consumer spending. You think about supply and demand. The other number then that jumped out at me was certainly retail sales. We had a big rebound. And the question that I'm asking is, are people spending money now in the hopes that they can get their purchasing done before the expectation of higher prices ticks in later in the year? We won't know that until later in the year, but we have had this resilience of the American consumer in the face of everything going on. We just like to spend money. If it's one thing that Americans have done really, really well, it's consumerism.
I often say that one of the pieces of American exceptionalism is our ability to spend. We do it better than anybody else in the world, and I think you rightfully point out that maybe some of that spending is front-running concerns of higher prices. We've seen that in the consumer confidence and the consumer sentiment numbers this week. A report on consumer sentiment, which, while inflation expectations have certainly moderated in the preliminary reading for July, there is still a fair amount of expectation that inflation is out there. And I think part of what Jay Powell and the Fed are combating is not the actual inflation in the system. It's the expectation that inflation is going to come. And it's one of the reasons why rates have to stay a little more restrictive. And so I think as you kind of put some of these pieces together, it is clear to me that, you know, the economic actors that are out there seem to be doing about as much as they can do to keep this humming along amidst what is an ever-present uncertainty. The rationale, the reasons for the uncertainty shift, but you know, I think you're dealing with imperfect information. You're dealing with an economy and a market in which things are shifting rapidly. And Art, to your point, I think kudos to the Fed this time around, at least, for being clearer on how to set those expectations. And of course, I think it speaks to, again, what we've been talking about all along, which is a Fed that's done a pretty good job. Of course, a lot of other things at play. You point out some of your 4 R's and your 3 C's, and not 4-letter or 5-letter words here, but just some reminders on maybe the opportunity set that's out there right now.
Yeah, I talked about in my show notes or pre-show notes, talked about the recovery that we're undergoing from the from the tariff threat earlier on, and the resilience, of course, of investors in the face of the tariff threat, and records being set, you know, despite the uncertainty. And the threat of a recession that was there really is dissipated. So this is actually, it's turned out well for those who are willing to stay in the game, which most of our clients were early on. And then I talked about China, you know, China chips and corporate profits. This is earnings season. Corporate profits are coming out, quite frankly, better than expected, but they always set us up for that. That's good for the markets, and they've responded. Chips, big news this week, NVIDIA got permission to sell its H2O chips in China and potentially ones into the future that they develop. I think this is a good thing. I think it's good to trade with China. And we want to sell things that are made by American companies. I'm not concerned about the competition. I don't think we should be. And then China, in the face of them being our arch enemy in terms of capitalism, which is shocking given that they are supposedly a communist country, they've mastered the ability to make things and to sell things. And so even though we're not buying as much over here because of the tariff threats, they've managed to sell that stuff other places. And their economy is still growing at 5%. So I'm very impressed with that. But I want to give kudos to you guys. A couple good articles that I think should be looked at in our website. One where you talk about, you know, investing overseas and different, you know, shifting wins, and then my buddy Steve over here with a great article on rebalancing. So it's not just starting with a balanced portfolio. With, you know, our portfolios up as much as they are, if they've gotten overweight to stocks that are higher priced, you know, Steve is suggesting you got to look at this. You got to rebalance periodically. And as your article alludes to, perhaps a little more overseas for your equity investments and bonds. I still like staying, you know, short, you know, on the yield curve because of this uncertainty about the federal deficit and increases in the national debt, which could drive long-term rates higher, even though short-term rates, you know, I think are destined to go lower in the short term.
And you're getting paid as well or better on the short side for virtually most of the risk spectrum. And so not a lot of reason to take too much risk in terms of duration, buying those longer-term bonds right now. Maybe that shifts a little over time, but certainly I think you're spot on there. It speaks, I think, to Steve's article on the importance of rebalancing and just, you know, our approach overall in that while we do believe that there is an allocation that's appropriate for most, and while we try to set portfolios, things change over time. Stocks run and you got to trim. Stocks fall and maybe you want to add a little more. And most importantly, I think some of the investing themes shift over time. And so it doesn't mean you're all in, you're all out. It doesn't mean we pile from one great idea into the next, but it does mean that how we choose to invest has to evolve over time to reflect those opportunities. Well, we enjoy doing the program for you. Hopefully you all get a chance to go check out the Air and Water Show this weekend as the Blue Angels flying by the window while we're recording. As always, we enjoy doing this for you. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.